We have Ryk Eksteen from Collins & Co. Presenting again, so I'll now welcome Ryk back to the stage. Thank you very much.
Hi, good morning. My session is going to deal with understanding the financial statements and try and put it in a nutshell and make it as practical as possible. The non-for-profit industry is pretty unique by the fact that it doesn't go out to make a profit or to generate a return for its members. It's also in a unique position where it can make an enormous impact socially and economically, and it's really an industry that's it's regulated, but there's quite a lot of leeway and a lot of different forms in which you can trade in. The financial reporting for a not-for-profit aims to demonstrate that there's effective stewardship of the assets by the management. It provides accountability, and it also provides the information to the users to make decisions. Non-for-profits are accountable to those people that provide them with funding, whether it's government or anybody else, and they also are responsible to account to the people that they provide the services to or the goods to. When we talk about financial statements, sorry, this way, where am I? Yeah, but there we go, thank you, sorry. Now I'm awake, so I'll try and stay awake. So when we talk about financial statements, there's three terms that are bantered around. The first one is financial statement, the next one is financial report, and you also get the annual report. I think the annual report is a pretty powerful document for the management of the entity to communicate to its users that all the information that's really non-quantitative. It normally have a chairman's report that talks about the aims of the entity, the goals, the strategies, and the achievements for the year. Then you also have a treasurer's report that explains to the members what the end result of the entity's performance really mean, and where was the good and where was the bad in that. It also normally contains feel-good stories that can show the users that this is what we're achieving, this is how we're helping our customers. And it's also a document that can tell us more about what's going on in the organization, about the activities and the operations. The terms financial statements and financial report have special meaning in the different laws that regulate non-for-profits. I'm thinking here about the Corporations Act 2001 and the various incorporated associations acts around the states in Australia. Financial statements contain information about the performance of the entity for a specific period, normally a financial year, which can run from the 1st of July till the 30th of June, or the 1st of January till the 31st of December, or it can really have any other year end depending on what the committee set out to do originally. It also will give you the financial position at a certain date, normally a year end, and will tell you what cash have been generated by the entity during the financial year. The preparation of financial statements are in accordance with Australian accounting standards are not mandatory. So if you've got a really small entity, you probably won't apply a lot of the accounting standards, you will apply some, but those on the large scale and the medium scale will probably apply most accounting standards. I will talk more about that a bit later. The financial statements can vary from entity to entity, and it really depends on what basis have they been prepared. The basis on which they're prepared depends on the accounting policies that the management have chosen to apply. There's a big change coming in the non-for-profit in the revenue recognition that will probably going to impact from 30 June 2018 year end, but it's something I think a lot of people still need to get to grips with. And that's why when you read financial statements as well, you need to read the notes to the financial statements, especially note 1, which will set out the significant accounting policies that have been applied. Like I said, the type of financial statement, it can vary from entity to entity, and really depends on 4 different factors. The first is what type of activities are this non-for-profit engaged in. Also depends on in which legal structure does this non-for-profit operate in. It also depends on what is the needs of the different stakeholders or users of the financial statement, and it also depends on which legislation is this organisation subject to. Now we get to the type of financial statements that we find we can come across in when we look at financial statements. There's 5 types. The first is financial statements that are being prepared on a cash basis. We will find that in really small charities or where maybe in clubs and that type of thing. Then you also have the accrual basis of accounting, where you take into account the expenses you haven't paid yet for the financial year, you take into account the prepayments for the next year, which is a bit heading towards in the right direction, but not 100% applying the financial standards yet. Special purpose financial reports, that's where management chose not to apply all the financial, the Australian accounting standards. So they pick and choose what do we want to apply, what makes sense to our users. For example, I own a building, but in their opinion, there's no reason to depreciate the building because it doesn't add any value to the information that I want to present. So that's a deviation from Australian accounting standards. So that will make that a special purpose financial report, which is, once again, when you read the notes to the accounts, it will tell you exactly what they've been up to and what accounting policies they chose to apply. Then the next set of financial statements is called the Reduced Disclosure Regime General Purpose Financial Reports. It's also called RDR. That's really the light version of the full-blown General Purpose Financial Report. What it means is that management have chosen to comply with all accounting standards, but the disclosure requirements under this specific standard allow them to disclose less information, especially under the financial instruments, which you can sometimes get pages and pages of notes which nobody read and doesn't mean a thing to the users of financial statements. It is important, but the people that understand it are pretty far and few in between. And then the General Purpose Financial Report, basically, where management applies all accounting standards to their full extent. You find that all the listed companies will basically be general purpose financial reports. You'll find a few of the large and non-for-profits will apply it, but most of the large and medium-sized will most likely go for the RDR, general purpose financial statements, which is just the light version. So what is the format of financial statements? Financial statements, from a point of view of incorporated associations and companies limited guarantee, consist of the management committee report or the director's report, which is gives us some idea of the goals and the strategies used by the organisation to get to where they want to go. Talks about long-term objectives, short-term objectives, and may even have some commentary on the results for the year. Then the next step is the statement of comprehensive income, which have different various names. I'm not going to go into all of them. We have the statement of financial position, we have the statement of changes in equity, statement of cash flows, the notes to the accounts, which is very important, as I stressed before, which normally note 1 will be the discussion of the accounting policies, while the rest, note 2 onwards, will discuss the numbers on the face of the statement of financial position in more detail. It will give you details of any possible future capital commitments, any contingent liabilities, and it's just a way for management to communicate with the users of the financial statements what is going on, what is important, and just really highlight the information that can have an impact on the way they make decisions based on its financials. Before we get to the common questions asked by users of the non-for-profit financial statements, let's look at who are the users. You can start with the management of the entity is a user. The members are users. Then you also get to the people to whom they deliver the services or goods. They are interested to see, am I going to get my service next year? You look at the general public, people that may want to donate to this organisation, as well as the funders of this organisation. And because they want to see, how are we travelling? Are we actually using the money that they received for the right purpose? Are they meeting the conditions? The 6 questions that users of a non-for-profit financial statement may ask. It's very similar to a for-profit. The only difference is for-profits want to make some money. Non-for-profit, not necessarily. It really depends on how management want to manage the organisation and what goal do they want to achieve. So the questions we are going to see is, how well has the entity performed in order to meet the objectives? I'll talk a bit later more about the objectives of the organisation. Is the entity financially sound? Has the entity fulfilled its obligations in order for the funding that it received? Did it meet all the conditions? Did it service all the clients it should have serviced? Does the entity have a viable and sustainable future? That has become really relevant now with the move towards the NDIS, where the government is aiming to limit the amount of players they want to deal with. So a lot of the smaller organisations in this type of industries are now being forced to amalgamate with bigger organisations, or really need to look really hard at their future and see, am I going to get funding in the next year or two? What type of lease commitments do I have for the next year or two? And really look at the big picture and see, am I going to still be around in 3 years' time or 5 years' time? Then, is this an entity, or does this entity provide a service to which I want to make a donation or want to contribute funds to? So, will me, as the public, then we want to support this organisation? And then it also will show how effective the management of the entity was. Like I say, that can be pretty subjective, depends on what the management set out to do, but the financial statements does tell a story. So when I read financial statement, there's a few different steps. When I get asked by a client to quote for a job, I'll follow these steps and I'll explain to you now. First, I need to understand the entity. So what is its objectives? And what legal form does it trade? What is areas, operations, and activities? And this information normally is pretty readily available. I can go and look on the ACNC portal if they're registered with the ACNC. I go and look for an annual report. Like I said, it's a really interesting document, which is a really good promotional document for organisation if they use it right. I look at a trust deed if it's a foundation. I can look on their website. And a lot of information is generally publicly available if you just know where to go and look for it. Like I said before, non-for-profits trade in various legal structures. The most common is companies limited by guarantee and then incorporated associations. There's also unincorporated associations as well as cooperatives, trusts, charitable foundations, public ancillary funds, and private ancillary funds. Step 2, read the audit report. That's always a lot of fun. I find it a lot of fun. Then you can really get quite a good gauge on what's going on by reading that. The purpose of an audit or review report is to provide comfort, but not absolute comfort, to the users of the non-for-profit financial statements that information in the financial statement is accurate. The auditor may decide there's a material misstatement in the financials, sometimes in the case of fraud, or that he could not obtain enough evidence to support a balance in the financial statements, which may lead to an adverse opinion, or basically where it withheld his opinion. Users of the financial statement should read the audit report and understand what was the conclusion, what was the opinion of the auditor, if there's a qualification, why was it qualified. A lot of the time, there would be a reference to the notes of the accounts in Note 1. They would refer to Note 1, and there would be a spiel there that tells you why there's a classification. I had an incident where we had fraud, so quite an extensive note on what happened to tell the user of the financial statements what happened, what's been done, what is the impact. Is there certain things we couldn't figure out what the impact was. Or the auditor also used emphasis of matter paragraphs. And that can be in relation to, is the entity a going concern? Sometimes you may be technically insolvent, but there's a reason because there's things in the current liabilities that may, it's like a prepaid income received, but it's not really refundable. So you are going to be entitled to that income. So that doesn't create a problem for you. It also can happen where the management prepares special purpose financial reports. That will write an emphasis of matter. There's 4 primary statements which we tend to look at. One is the statement of comprehensive income. Then we have the statement of financial position, the statement of changes in equity, and the statement of cash flows. Statement of comprehensive income will give us more details of the income the entity received. I think the problem is if they strictly apply the standards, they don't normally put in a detailed income statement at the back. So you have some detail from the notes, some detail from the face of the statement, but sometimes you need a bit more information. It also gives you the idea how to spend the money and which expense categories, and will give you an idea of the surplus or the deficit of the organisation for the year. It's always important to keep in mind with and a lot of time we won't know that is what did the management try to achieve in this financial year? Did they want to make a surplus, or just break even? They made a deficit by accident because something unexplained happened or unexpected happened. And a lot of the time, is a good financial performance does not mean a good surplus does not necessarily mean a good financial performance. And a lot have to do with the way that management decide to account for their revenue. So they, for example, a political party will spend a lot of money in the lead up to an election for which they will not receive any income until the year when the election takes place and they receive the election funding from the government. So there will be quite a distortion in the picture, big loss, big income, big loss, big loss, big income. So it just depends on how the management decide to apply the accounting principles. Well, this 4 statements should always be read in conjunction with the audit report and the notes to the financial statements. The statement of financial position will reflect the assets, liabilities, and funds on hand at a specific date, normally the balance date or the year end. Assets can be classified as current or non-current, the same with liabilities. Current asset is cash, trade debtors, prepaid income, sometimes a bit of inventory. Non-current assets, property, plant and equipment, maybe some trademarks. The difference between current and non-current is that current assets is those assets that the entity expect to utilise within or expense or realise in the next 12 months, so that's really the next financial year, while as non-current assets, it's really a longer-term view. Same on liability side, we've got current liabilities, accounts payable, trade creditors, amounts payable to the ATO, annual leave, while your non-current would be long service leave. We may also have a current portion. Borrowings may have a long-term or short-term borrowing, depending on the the terms of your loan. There's three important questions which you want to ask when you look at a statement of financial position. When I ask the question, does the current asset exceed the current liabilities? So can the entity pay its current obligations within the next 12 months? Otherwise, it's technically insolvent. Like I mentioned before, that may not be the biggest train smash, but it could indicate a problem. Does the book value of the non-current assets reflect reality? I think you'll find that unless the entity has a reason to dispose of the fixed assets and run into some kind of trouble, that the value of the fixed assets, I think, very seldom reflect the true value of them. But it's got a value to the organisation because the assets are used in order to produce the services. So there's some value in use instead of being just looking cold. Does it have a value if I suddenly have to sell up and get something for it? Because I think very seldom you will get what it's on the book. The last question you need to ask, which is very important, is are the provisions for employment entitlements, is that correct? I've had instances, especially at a childcare, where the provision for sick leave was pretty low because we never paid us out, people don't get sick. The liability ran, I think, up to $100,000. They had some financial difficulty due to fraud, and they decided to go to cluster management. So the cluster manager came in and said, okay, we'll take over all the employees. We'll take over all the entitlements. So suddenly, there's $80,000 not on the books. And that created a problem because they didn't have the cash. So that is something to be really careful of to ensure that your employment entitlements is correct. That's probably something I'll touch on a bit later as well. Then the next one is statement of cash flows. That will show the actual inflow and outflow of cash into the organisation for the year. A lot of the time, especially in for-profits, you will hear the question, but I made a profit, I made a lot of money, why don't I have money in the bank? And if you read the statement of cash flows, you realise that the entity had a huge turnover, but they got huge debtors. So that profit didn't necessarily turn into cash flow. And a lot of the time the reality is the business did not generate any cash in the financial year, and they financed the operations for that year by loans or higher creditors, or the fact that they had cash on hand the year before, which got utilised in this current financial year. So it's a pretty powerful statement to read, but it can also be pretty tricky to understand. Not going to say a lot about a statement of changes in equity. It just shows you, did the entity make a profit? Did it make a surplus? Did it make a deficit? Was there any movements in the reserve? So did they revalue their fixed assets? Or is there any other reserve which they actually have on the books, which is not that much anymore? Or it's not really that allowable anymore. So it really tells you that story. In conclusion, so the non-for-profit financial statement really can tell you about the performance of the entity, the financial position at the end of financial year, and how was the activities financed during that financial year. The users need to understand the financial statements in order to understand what information they are looking for. And a lot of the time, you won't find all the answers in the financial statements. That's why that annual report comes in handy. It tells you what have they been up to. And you can, so the answers to the questions you may not find is, what is the funding agreement? What is the terms of that? And what do they actually do? Because a lot of organizations can get up to quite a lot of different activities which you can't always see from the financial statements. I don't know if there's any questions. Couldn't have been that good. Yes?
You asked about the provisions for the annual leave, etc. Those questions to ask. How would you check that those provisions are adequate?
Well, a large problem we sometimes find in non-for-profit is that the information to calculate that information is not that great. So it really relies a lot on the record keeping of the entity. So if they've been pretty slack, which can happen sometimes, it's really hard to work out. The long service leave you can work out pretty easily because the start date, and you can work it from there. If the records of the entity are not complete, you may have a problem. So that's something that's you really need to pay a lot of attention to. Sorry, yes?
When do we find out about the new requirements for 30 June 2018?
At the moment, they're in an exposure draft. I think been to training about a week or two ago, and the presenter himself told me he's not even got a full understanding what's going on yet. So I haven't looked at it myself personally, but I think there's a feeling that will also get kicked out a year as well. So it's a really difficult one because they talk about how do you recognize the income organization. So you have to go and look at what income are you getting, what does your funding agreement say. You may get like a registration fee for the year as a membership organization, or you may get an event income or different types of income. You need to go and see when is that income, when do you think that income is going to flow into the business. So sometimes the reality does not match what the accounting standards say. So I think it can be pretty complex. I just haven't looked at that standard yet. I think it's ED 260. So, but yes, Ralph.
With that even distinguishes between grants, gifts and things like the treatment on that. I've only attended a course the other week ago,
okay.
And with Karen and Ridley, and
yes.
It's still a way off.
Yep.
So they're asking for comments on that. I might ask you about that.
Yeah.
Your comments on that later, on a private basis for us.
Well,
I know it's still early days.
Yeah, I mean, my view always been you look at the conditions, what is the conditions attached to the funding? A lot of time, a lot of the stuff will be you'll recognise the income when you actually receive it.
The other thing is sometimes you don't always get adequate documentation.
I know.
That's the big problem.
So I think there's going to be a lot, there's going to be a bigger onus on the entity and their financial staff to ensure that they know exactly what's attached to that money, what conditions. There's a lot more focus on what should you do with it and what is attached to that money. I haven't, like I said, I haven't looked at it, but I've heard it can be a bit interesting. So, and I think the biggest problem is we need to educate our clients as well that they don't wait for 2018, but really start looking at it now. So that's something I will do this year is just basically get something out to my clients saying, okay, this is coming, this is what we expect to see once we have a better understanding of that, and I'll communicate that to my clients. Yes.
How do we choose a good auditor?
You go for the best. I think it's a lot of time word of mouth. I mean, I'm an auditor. I tend to get a lot of my clients with referrals. We also, obviously, you can go to Pro Bono website and they've got suppliers on there. I mean, word of mouth is, or you say, okay, I mean, I get plenty of tender proposals I have to do, so they sometimes ask for references, so then I use my nice clients in the room for references, so it can be a challenge. There's people that does not have a good reputation, but you wouldn't know that, so.
For a minute there, I thought you said dinner proposal.
No.
If a lunch needs to get you over the line for Collins & Co. We'll wrap it up there because we are running a little bit behind time. I know, Maria, we're taking up some of your precious time for your presentation.
Sorry.
I know that there's a couple more questions.
I will talk to you lunchtime, or just come and see me, please. Thank you.
Thanks very much, Ray.